Welcome to the Real Property and Financial Services section February Brown Bag. I'm Tina, the chair of this section. Today we have a fabulous presentation by Colliers International. Is this the peak? Will be a discussion from Colliers market experts as to where Hawaii's commercial real estate market is heading in 2016. This will be an interactive presentation, so you guys can raise your hands if you have questions. And those of you on the line, feel free to unmute and ask a question, if you have a pressing question. So, some brief introductions before we begin. Ladies first, Sarah Morihara is the president and managing director of Colliers International. She oversees the operations of the brokerage, property management, and research and consulting divisions. Prior to joining Colliers, she practiced at Cade Shetty. And then over here we have Mike Hamasu. He's the director of consulting and research. In addition to managing the research efforts in the collection of commercial office, retail, and industrial market information, Michael also established the company's real estate consulting division. And we have Nathan Fong next to Mike. Nathan is a senior vice president and retail services group leader. I'm sure if you've ever represented a landlord or a tenant at a major shopping center in Hawaii, you have met Nathan Fong. Bill Froelich is a senior vice president specializing in sales, acquisitions, and leasing. He is also the industrial division manager at Colliers. And then next to Sarah is Brandon Bera. He's a senior member of the Office Services Division, and he focuses in office leasing, sales, and acquisitions. Okay, take it away.
Yeah.
My only job is to do introductions, so I'm all good. No, I'm. The three experts that Mike and I have here with us, they're all division leaders of their respective disciplines and also members of the investment committee, so they can add color to a lot of things that Mike will talk about. Mike, you're up, and no pressure, but she said it's a fabulous presentation.
Well, thank you, Tina, for setting us up. We appreciate the invitation to come and speak to you. We also appreciate the fact that we are actually the first for this year for this group in terms of presentations that they're about to hear. So we have to set the bar extremely high so that everybody else follows, right? No pressure. All right, so the reason why we picked this topic of as the market peaked is because we've interacted quite a bit with not only the legal community, but the developers and the investors in our marketplace. And after hearing the stories about what happened with McNaughton and Kobayashi with the Vita, everybody's like, oh my God, is this the canary in the coal mine? Is this the precursor of what's going to happen in the future? And that's why after every section of our presentation, we'll ask that question to our experts. Right? And they will answer that question, right? Okay, so let's start off with our agenda. Basically, very similar to what we did in the previous years. We start off broadly with the investment market, and then we work into the separate disciplines.
Here, I'll move over, Bill.
You want to be on camera?
No. Can I sit right here so I can see?
Okay, so we'll start off with the investment market, and many of you have been involved in transactions in commercial real estate, and you know that the market is actually booming. Typically what we do is we start off with the real estate cycle. We create a kind of a graphic that shows that many of the property types are in the expansion mode. And the expansion mode for us is basically vacancy rates are declining, rents are increasing, development activity starting or actually in full-scale mode. And for this graphic, you'll see on the far right side is that luxury condo high-rise market kind of is entering into the hypersupply mode. And in the hypersupply quadrant is basically when there's maybe a little bit too much development happening, you're starting to see prices be affected, you're starting to see slowing in the development cycle. For those of you involved in real estate, you know that we always say follow the money. And mortgage placement or originations are on the increase. It's actually increased in the last several years from about $1 trillion to about $2 trillion. So, you know, as with the movies, Jerry Maguire, you follow the money and the money's going into real estate. Another positive factor in commercial real estate is that the delinquencies are down amongst our financial institutions. Luckily here in Hawaii, most of our banks are fairly solid in terms of their performance levels, but you'll see that the delinquency rate dropped to 1% about, which is kind of reminiscent of the activity prior to the last recession. So year-end commercial real estate for the U.S., and this is in billions of dollars, is on its 6th consecutive year of increases. So, you know, again, follow the money. The money's flowing into commercial real estate. Here in Hawaii, this slide that we particularly like is that we're showing that our transaction sales volume has been elevated, or is at an elevated level. Typically, over the last 15 years, the average transaction sales volume is about $2.5 billion a year. So whenever that number is above that $2.5 billion, we know that the market conditions support additional transaction activity. So at year-end 2015, we've identified $4.5 billion of commercial real estate transactions that have occurred in our marketplace. Mind you, transaction counts are down slightly and sales volume is down slightly from 2014 levels. So if you got that question in the back of your mind, has our market peaked? You'll have to wait for the answer for that. All right, where is all the volume? Where's the dollars being spent? 64% of that $4.5 billion has been in retail. We'll explain further why that is, but in a typical year, you know, as you probably are all well aware, resort and golf typically generates a large percentage. It's just a unique factor in some of the transactions for this past year had focused on retail. The reason why I put this graphic up, which kind of identifies not only the U.S. trend line, but the Hawaii trend line, is that if you look on your far left side, our market kind of peaked in 2005 in terms of sales volume. And the blue bar is actually the U.S. number. So we peaked about 2 years prior to the U.S. in general. So if you go back to the far right side, you'll see that, you know, if our sales volume has actually started to slow and transaction counts are starting to slow, are we trending in a particular direction? Of course, one data point does not make a trend yet, so we'll see. Where's the dollars being spent? Roughly 14% of the sales volume dollars of that $4.5 billion was spent by local investors, which means that 86% was offshore international investors here in Hawaii. From a transaction count perspective, 69% of the transactions were done by local entities. So if you just kind of did the ratio of the number of sales volume versus the number of transactions, offshore entities spent well in excess of $45 million on average per transaction, whereas local people or local investors were somewhere south of $4 million. So we get the small transactions if we're a local investor. Institutional guys and international guys are the ones that spend the hundreds of millions of dollars locally. So this kind of explains where most of the dollar volume for the retail concentrated. Roughly about $1.8 billion was spent in our regional malls, and they weren't even for the entire shopping center, only fractional portions of the shopping center. The two Ala Moana sales, the 25% was actually acquired by Australian Super, which is an Australian pension fund. The ProRidge Center was acquired by O'Connor Capital from Glimcher, and Glimcher actually sold their whole portfolio, or actually 49% of their portfolio, to O'Connor. This ProRidge shopping center at $492 million is actually an estimated price for that portion of the portfolio. And the third transaction, Ala Moana Center, 12.5%. That was to TIA CREF, which is another pension fund on the U.S. mainland that acquired it for about $450 million. So it's interesting. Nathan, any comment on why you think people are targeting these regional malls here in Hawaii?
Yeah, so if you look at Ala Moana and Pearl Ridge, those are real stable assets. The barriers to entry is extremely strong. I mean, there's basically no competition for that. So, and then with Ala Moana expanding and the condos or townhouses or whatnot, it's a pretty safe bet. So, and the foundation is already there. It's already a strong, stable, proven asset.
So we look at cap rates, and cap rates are typically the return on the investment on the sales price. And we're seeing that cap rates have compressed over the number of years, but it looks like it's beginning to slow. Bill, any comment on where you think cap rates are going to be going in 2016?
They're already, like Mike said, so low, and interest rates are bouncing off the zero bottom, but there's so much money out there looking for assets, especially multifamily and industrial, that a lot of the data that we're seeing at least suggests that cap rates will remain the same, if not inch, 25 basis points lower, or something along those lines. So I can't imagine them going much lower. For multifamily apartments, 4.5, industrial 6. So those are already pretty low rates of return as it is.
Okay. So a quick summary of the investment marketplace. We're seeing that for all of you who look at the economic news from a global perspective, you're seeing the stock market doing this, you're seeing bond yields drop, you're starting to see high fluctuation in regards to currency abroad. I mean, if you're invested in gold or copper or even oil, you're taking it in the shorts. So alternative investments are not looking so good. And that's what's attracting a lot of investors in their commercial real estate. So that's why we're seeing elevated levels of investment activity in real estate. Locally, similar. Local investors still remain very active in our marketplace. Any comments or questions regarding the investment section? No? Okay. Everybody's in agreement, right? I like that. All right, we'll go on to the retail market, and we're seeing a lot of development activity in the retail market. And in the past year, actually 2015, the biggest news was the opening of the Evo wing of Ala Moana Shopping Center. Vacancy rates rose slightly, up to about 5%, but you'll note on the far right side that there was about 460,000 square feet of positive growth. This is it's called net absorption, which is basically the change in occupied space. But this is when new tenants move into the market and expand. Nathan, any comment regarding Ala Moana and its impact on the retail market?
Yeah, I mean, it's Bloomingdale's. That's pretty amazing. We've been waiting how many years to get them. But just to give you an idea of who's expanding, we kind of went through our list and we were surprised. There's actually a lot of retailers still in expansion mode. TJ Maxx, Ross, the Longs, the Walgreens, they're still expanding. Kamakana Ali'i, Victoria's Secret, H&M. Two of the movie theaters expanded, one in Kapolei Commons. They have a consolidated deal at Kamakana Ali'i, so it's pretty nice to see. We are starting to see a little bit of softening in that mid-box 10,000 square foot range. But the shop space, 1,000 to 2,000 square feet, and then the 4,000 to 5,000 square foot size spaces are, there's activity, which is great.
We also look at some of the economic factors that support retail, and we know that the tourism sector or the hospitality sector is a big supporter of retail spending. We've hit record levels in tourism. Single price, median home price, if you've been out there looking to buy a home, the median is above $700,000 now. And usually if your home price appreciates, you go out and spend money because you feel richer, and that's kind of the wealth effect. In fact, since you're all lawyers, how many bought new cars in the last year? Oh. All right, so you must be the managing partner. All right, so you have all this positive news. Both resident market and tourism market are supporting additional demand in our market and resulting in rents escalating. So in the past several years, we've averaged about a 5% increase in rents, which is actually a very positive growth in terms of rents. But what's funny is that retail sales actually posted a slight decline. And we think that's because the strong US dollar is holding back the spending by the Japanese. And Japanese, of course, is one of our largest international tourism markets. So we're seeing a slight decline in retail spending here on Oahu. Any thoughts on that, Nathan? No? Okay. All right. We create our own index because we have a managed portfolio of a number of shopping centers throughout the state. And by using this portfolio, we actually record retail sales from our retailers in those shopping centers. And we're seeing that, right after the recession ended and started to improve in 2012, the performance for these retailers jumped significantly, only to kind of settle down to a nominal 1 or 2% rate in 2015. So. I know all of you can see where this is an eye test for the back of the room. Actually, we summarized it for you. On our horizon, we have over 4 million square feet of planned retail development in our marketplace. Mind you, we track 16 million square feet here on Oahu, so that's a 25% jump in inventory over the next several years in retail here in Hawaii. Any comment on that?
No, not only that, but we're starting to see, or we are seeing, existing projects being renovated. So a good example is, Town Center Mililani that was purchased a year ago. That's going through a total reimaging process, and money is being spent there. So it's nice to see.
So who will occupy this stuff? Will it be people who are not here now?
You have some retailers who are not here now, but most of them already have their foot in the ground, on Hawaii. They're looking to do their second or third location. But if you look at, the market entry from a national standpoint, okay, they can do Kapolei, the DeBartolo project. They could do maybe something at Ala Moana or Ward, and then they could do another location maybe in Kailua or somewhere. So, typically, where Hawaii would be such a strong, market to enter, where they could only get one store, they could get 3 stores right off the bat, which makes sense for them, right? Okay, we're bringing down our people, we're hiring, shipping costs, things like that. So that's what makes it nice, is we're seeing development in different trade areas, which is good.
Okay. Any of you familiar with Kaka'ako and the 5,500 units planned? That is drawing a lot of attention to the urban core in terms of development, and that's partly the reason why you have expansion in the ward centers as well as Ala Moana shopping centers, since they can capitalize on the increase in the residents in those markets. So our forecast going forward for 2016 for the retail market is that a vacancy rate will start to escalate. We're going to hit about 7.5% by year end, and primarily that's due to the number of new developments that are planned in the area. For the most part, not all of them will be 100% leased. So there'll be some vacant space that these projects will be delivered with, and that will result in vacancy rates rising on Oahu. In a typical market, retail market, usually about an 8% vacancy rate is what we consider a kind of equilibrium point for the retail market. So anything significantly above that, then the landlords will have to start wondering and start to negotiate a little more aggressively for the tenants in that kind of marketplace. So we're fairly optimistic on the retail market. We still see that the economy will continue to be fairly strong. We see a lot of development going forward. So with new development, vacancy rates tend to fluctuate and rents start to, kind of move sideways. So now, since you're the first person, I'm going to ask you, has this market peaked?
I think we're at the top. I don't know if we're at the peak, but I do think we're at the top. And so, I think, we're still going to continue to see progress and seeing deals being done. going forward, we're probably just going to have to be a little more creative and a lot of hand holding to make sure things get to the finish line. So,
Well, the good news is the visitor counts are high.
Yeah.
And are not projected to slow over the next year. The downfall is that the cost of hotels and travel is so high. None of the airlines have brought down their rates as a reflection of gas prices. So that's where we're not seeing the robust retail sales growth. The monies are being diverted somewhere else.
So in a 9-inning baseball game, what inning are we in?
I say we're in the 8th or 9th, but there's always overtime, right?
Like a true broker, good job. All right, we move on to the industrial marketplace. And one of the questions we raise is speculative building on the horizon? Now, the reason why we throw this question out is that once we describe this market, you'll start to ask that question, right? Vacancy rates in the industrial market have fallen to 1.65%. We are, at this point, the tightest market in the entire country. This is, in the history that we've tracked the industrial market, this is the lowest vacancy rate we've ever recorded. Okay, I just wanted to stop because I want you to kind of soak that in. All right, things that support expansion in the industrial market is we look at wholesale distribution sales. Well, the reason why you have that softness in the retail sale or in the wholesale sales is because the retail market was a little soft, right? You saw a slight decline in retail sales. Wholesale distributors are major users of our warehouse here on Oahu. Contracting sales are up, and we're seeing that construction is starting to pick up significantly. So we look at the permit volume, which everybody kind of refers to as the way to predict where the construction market goes. And we're hitting a record here. This is at year-end 2015, we're at 2.43 billion. And, mind you, we can rely on DBED all the time. We just look out the windows and see all the cranes, and you kind of can realize that construction activities is starting to ramp up significantly. From a rental rate perspective, we're on our 4th consecutive year of increases in rent. But this number is a little misleading, and I want to throw this over to Bill because he'll say, if you had an empty warehouse in Kaka'ako, what kind of rent could I get for that?
Sky's the limit. Industrial market in Hawaii, I was just thinking, it's kind of like going to Tahiti, right? It's like there's only high season and then high season, like high season and then higher season, right? And as Mike mentioned, 1.6% vacancy rate, when equilibrium should be 6 or 7. And if you saw that graph, we haven't hit that. I've been with the company for 10 years and we've never had it in what the market would consider an equal industrial vacancy rate. So for our population of 1 million, we have about 40 million square feet of industrial space. And compare that to a place like San Jose that has the same 1 million people, they have 400 million square feet of industrial space. And for an industrial rental rate average, we're about 3 times the national average. So retail rates are not that high in some states. But, to answer your question, in Kaka'ako, a lot, $1.50 or more.
Really? All right, so we do a regression analysis. Each of these dots indicate an actual negotiated lease. So if you look on the far right side, it's that curve is starting to pick up pretty quickly, and that number is actually somewhere near $1.25 to $1.30, which is where if you had a warehouse space in one of these peak markets of Kalihi, you could probably get $1.30 plus in rent.
Why the increased spread range increase?
Right, that is correct. So basically on the bottom would be the lowest quality space, which is I think about 50 cents or so. And those are usually open sheds with very little amenities. And then on the top of there, you got a $2 rent. And
I did that one. The yellow one. I think the explanation for the spread can also be that our market is so incredibly tight that space is getting eaten up that would normally just languish on the market.
All right. Good question. We also look at land prices. So if rents are escalating at a rapid pace, market's at 1.6% vacancy rate, why don't we have a whole bunch of developers jumping in and let's build some warehouse space? Well, if you look at the land values here in urban Honolulu, land values are somewhere between $100 and $140 a square foot. So if we were to build a warehouse, in a nice little lot here in Kaka'ako, right where everybody wants to be, how much would it cost to build?
Yeah, so land at 140. If you consider 50% lot coverage, right, that's 300 in the land, and then 130 to 150 for just a metal warehouse, almost $500 a square foot. That's what I paid per square foot for my home in Hawaii Kai. And so if you back that into a 6% rate of return for an investor, you need over $3 per square foot in Kaka'ako. So the only place that industrial development can potentially begin now to pencil is in Campbell. And we need rental rates to rise 15 or 20% for that to happen.
Okay. So we threw this graphic up. It kind of highlights where all the vacant land parcels are. And as you note that the map's not moving anywhere, staying in West Oahu out in Kapolei. And basically go west. That's basically where the land is. Vacancy rate forecast, we're looking at somewhere south of 1.6%.
It's basically a zero vacancy rate where we are now, right?
Right.
Space that's decently priced in a decent shape goes incredibly quickly. Yeah, stuff that's vacant is just the normal turnover, people moving out and in. It's basically a zero vacancy rate.
So, our quick summary, tenants are out there scrambling for spaces. If you represent an industrial tenant and they're asking, oh, can you help me with my negotiations? Just tell them pay it, right? Pay whatever they ask for.
Yeah, I actually wrote, and I won't share it now if you want to talk. I said, well, what am I going to talk about? So I wrote the 8 things that I think are negotiable items in a lease and the 5 things that I see that are not that I see in leases trying to be negotiated.
Okay. You can meet them afterward and talk about it. You'll start to see that rental rates are, we project a rental rate spike by the end of this year. If nothing's being built, demand continues to grow in a strong economy. Landlords are kind of holding you by your negotiating points. Urban Honolulu land. Is prohibitive to build. I mean, unless you want to build a warehouse that charges $3 rent. And then we represent significant amount of land that's available on the market for sale out west, and that land is selling briskly. Okay, did I say that correctly, Sarah? We're promoting our market. So anyway, to move on, is this market peaked yet?
Probably not. Probably not.
Okay. Any questions for industrial market? No?
I have one.
Sure.
All the storage units that went up about 5 years ago, they seem to flourish all over Oahu, especially Honolulu. Do they get filled up, or will they prospectively be used for something else as time goes on?
Well, in our recent analysis of that sector, actually there was a overbuilding situation a couple of years ago. At this point, we're starting to see that is actually getting to be an attractive investment target again in terms of self-storage. And we're thinking because of the tight market conditions, a number of people are using these self-storage units as their base for their offices, right? If I were a medical distributor and I had bunches of stuff that I have to hold, I'll just store it in the self-storage unit and use that as my, kind of my hub or my distribution center. So to answer your question, a lot of that empty space in those storage units have been absorbed. Any comment about self-storage?
No, that's right. And the absorption that's required for those to pencil very well is not very high. I mean, it's less than 50%. When those are less than 50% occupied, they're penciling very well. They're $3 a square foot, right?
Yeah. So we should convert your Hawaii Kai house into a self-storage unit?
It's already multi-tenanted. So.
All right, we move on to the office market. And our comment is market volatility is anticipated. Vacancy rates Okay, you've seen retail, you've seen industrial. Now, office market is about somewhere south of 13% vacancy. Don't tease. Jeez.
Hey, go find a place to lease.
That's
and
why we
then laugh.
separated
Yeah.
Historically, the vacancy rate has kind of hovered between 12 and 14% over the last 6 or 7 years. What's kind of interesting is that if you look at the economic factors supporting office market, you got an unemployment rate that's dipped below 3%. So you figure we're near full employment. You're looking at office jobs. Look at how many office jobs have been created in the last several years. It's been growing for the last 3 years. And, you know, if you just look year over year, office jobs, 3,300 jobs, the second largest job creator in the island of Oahu. Brandon, any comment? Why is it that you got all these positive factors, but the office vacancy rate is staying flat?
That primarily just because the utilization of space is different than what it had been in the past. So more people stuffed into less space. So even a growth in employment unfortunately doesn't, translate into a growth in occupied space.
Especially all you law firms, you've gotten rid of your libraries and you've probably
14 by
sharing your
14
office
offices.
spaces. You know, you use cubes. Maybe that's why. Right? Yeah. It's all your fault. All your fault. All right, average rents, we're seeing actually a slight increase in rents, which is kind of counterintuitive, thinking that, hey, if the market's at 13%, it's not really improving, why are rents improving? Well, there's a differences in market. If you're in urban Honolulu and CBD or Kaka'ako, vacancy rates at 13 and 14%. But if you're out in Pro City, or if you're out in Kaneohe or Kailua, or if you're out in Kaimuki or in Kahala, those markets have vacancy rates sub 8%. So when we average things, we're averaging everything together. So those suburban markets are actually pushing your average rent up, whereas if you're in downtown, it's not reflective in these rents. So we look at CBD dotology, as one of our bosses calls it, and basically we're seeing rents kind of flat. So if you are all negotiating for their renewals here in downtown, would you say it's a landlord's market or a tenant's market?
I'd say it's a balance. Honestly, it's in the eyes of the beholder. I think there are certain landlords who like to believe that it's a landlord's market, but I'd say you're probably going to still lean a little bit more towards the tenant's market, just because the vacancy rate hasn't changed a whole lot from when it was considered a true tenant market. When it was 14% vacancy. So you're still in a good position, and really either way, it depends on your particular building. I would say more than anything at this point.
I throw this up because it's kind of interesting, because if I invested in the operating expenses of a building, I'd get a 6% return for about 15 years. Why are you laughing at that? But if I invested just recently, I wouldn't get any return. And that's basically because the cost of oil has dropped significantly and the operating expenses of the building have just kind of flattened. 25% of a building's operating expenses are primarily electricity. So for all of you who use air conditioning and lighting, that's where a big portion of your operating expenses are. Now, besides the fact that you're seeing a vacancy rate that looks very stable, going out even further, 2016, we're seeing a number of game changers ahead. Brandon, do you want to kind of explain how the state's potential acquisition of Elite Place or ASB's development out in Ala Park
Sure.
and next year is going to impact the office market?
Yep, I'll touch on all of those. State of Hawaii, and there are recent rumors that the appraisals didn't come back as needed, so that there's a chance that this won't go through the state taking Elite Place, which, I'll avoid the political aspect of that, I guess. But if that were to happen, just as an example, it would really be an interesting situation to see how it plays out, because the state of Hawaii occupies a fair chunk of space downtown and in other privately owned buildings. So they're going to vacate what are normally Class B and Class C buildings and go into what's arguably the second nicest building downtown. So that removes a Class A asset. So the competitors of all the Class A owners now have one less competitor. However, the Class B guys that are losing the state of Hawaii that are paying rent right now all of a sudden have to dive on their rates because they're going to have a ton of pukas all over the building. So it would actually create a gap between the Class A and Class B, a pretty significant gap, I think. Whereas right now, there's very little gap between Class A and Class B. I mean, Bishop Square, just for example, has some of the cheapest rents downtown, and most people consider it really the epicenter of the CBD. And they're lower gross rents than you'll find at a Class B building down the street. So it'll be interesting to see if there is a premium placed on a Class A asset if the state does purchase. ASB does appear that they are going through with the development, so that'll they'll shift some of their current lease space over to that campus. It'll create a little bit of a knock on the vacancy. Next era, Hawaiian Electric, who knows at this point what will happen with it. I think in general, whether that happens or not, I think there's going to be just sort of a reevaluation of how HECO operates their space or how they utilize their space. So that next era's involvement might only be in a couple years if it was to happen in a couple years. The staffing, if some of it were to go to the mainland, then it would be more significant. One other thing that's not on here is Pacific Office Properties, and just how it plays out with the Scheidler portfolio, and they're maturing loans at the end of this year.
Great.
Good question.
I just wondered on the purchase this the electric tower. Do the numbers work out that it's attractive to the state to purchase a Class A building?
It's a great question. Well, taxpayer dollars, I guess. So I would say it would probably take a pretty in-depth analysis to really understand all of their other buildings, what they're paying, and what the management cost would be for them to own and operate their own. So it's hard to say. I think it's definitely pricey, but it's all about what opportunities are available, at any given time. So that was as PC as I could get it.
There was a bill in this last session for mandatory sale of the fee interest. Any chance of that happening in commercial real estate?
I think you're the better group. to
Yeah. Here.
Yeah.
Switch it up.
Doesn't it come up every year?
It's just held.
I don't know.
Held it for that, or
Yeah.
is there any possibility of that happening?
It's crazy.
Yeah, I would be surprised.
Seems far-fetched to me.
Do you guys hear anything about that?
I can imagine the legal battles that would ensue if that were to happen.
I know Bishop Estate is really fighting it, but I'm thinking like Century Square, owned by the Catholic Church. What's the chance of them selling their fee interest? Because the office units are leasehold right now, and a lot of people wondering if we can make them sell.
Yeah.
Get them to sell.
Again, I think that's a real legal battle because this is the livelihood for these nonprofits, and to take away any future funding, to me, that's questionable. So, yeah, I think it's more of a legal question than a commercial real estate question.
Well, it's a different situation, I think, from residential, because all across the country, commercial is leasehold. Whereas, residential, they were in the pockets.
But the effect to Kamehameha schools or, the other charitable trust, Queen Emma, QOT, all of those, I mean, it would be devastating for them if they had to give up those lands.
Thanks, Sarah. Okay, we create our own model in terms of trying to forecast where the office market goes. The blue line is actually tenants looking for space in the market. The yellow line is the vacancy rate. So as you can see, in the last several quarters, we see a lot of volatility, up and down. So normally what happens is that
You put them to sleep.
The musical interlude by Jake Shimabukuro.
Brought to you by Colliers. Yeah.
To disconnect the telephone, so people will have to call back in since somebody just placed us on hold. So I'm gonna disconnect and then you guys call back in, okay? Thanks, bye-bye.
Thank you. Brandon, you talk about the office market and
This always
music
happens, I tell you.
It is a perfect segue.
They're just trying to drown me out. The guy who keeps speaking at the Grammys, you know.
Joining conference now.
All right, so our forecast going forward for 2016 remains a whopping 12%, and they put us on hold again.
Shoot, I apologize to our phone people. I'm gonna have to disconnect you guys, and feel free to watch the video on the website when we post it later. Thanks.
That was great.
Okay, please continue, sorry.
No, no problem. We appreciate the.
They didn't tell them who it was, so they'll
Oh.
remain.
All right, so we're actually projecting a little bit of positive absorption for 2016, but vacancy rates still remain elevated. As Brandon alluded to, we have a number of game changers that are on the horizon, so anything could happen, but we think it's moving in the positive direction.
It's going in a direction.
All right, so we have a quick summary. We know that many of the factors, economic factors, remain positive for the office sector. So Brandon, has this market peaked?
I thought you were going to ask me the baseball game question because I had that already.
Well, what inning of the baseball game are we?
I'd say we're in the 8th inning of the All-Star game because nobody really gives a crap about the All-Star game. And it sort of doesn't matter what happens at this point because we're.
Very good. All right, I like that. Before we close off, I'll leave it open to Sarah to make final comments, and maybe she can tell us, out of the office, industrial, retail, and investment markets, has the market peaked?
It's probably the question we get asked every day. Actually, the McNaughton Kobayashi group pulled out a veto, which was huge for a lot of people. It signals something to the community. And we think they pulled out of another project. So I would say from a developer's perspective, a conservative developer's perspective, they believe that we've peaked. In industrial, it's all different because in industrial, there's just no inventory. So we haven't hit a peak. And it's going to get tighter and more competitive. In retail, there's going to be a lot of inventory just because of the new development. In office, we didn't talk about Kamuali'i.
Kamamalu. Yeah.
Because that's a building that's been sitting vacant for, 10, 15 more years. And so the state is renovating. They'll come online before the end of this year. So they'll pull some of the state offices into that building, which will have yet again another ripple effect through the office market. And just office is it's interesting to me how dynamic it is because everyone's renovating, they're creating a lot of collaborative spaces, so that means individual offices are shrinking in offices across all sectors. File rooms are largely disappearing because everyone's going electronic. Server rooms are not requiring the same footprint that they used to require at one point. So it's going to be interesting to see what happens in office, and yet at the same time I say that, and I think office users are realizing that whole bullpen idea with all open space is not exactly conducive to productivity. So there might be some movement back to some privacy a little bit. So I think office is going to be fun to watch going forward just because it's so dynamic right now. But I do think retail has some challenges because of the new inventory coming online, and definitely, the news about the sports authorities and the Macy's of the world, that's causing hesitance on a lot of people's part. But again, for the small users, there's, good competition out there and great opportunities for them, because instead of investing in one store, you can get multiple locations and get some economies of scale in place.
Yeah, and so our advice, to our clients is, at this time is, hey, if we have things that are on the table or stuff that's active and it's in front of us, let's push it towards the finish line. Let's not be too picky. Let's be flexible on the negotiation, and let's see if we can come to terms. Because just in case.
Great summary, guys. So before we leave, I want to ask a question.